The Fed is cutting interest rates, but your mortgage isn't going down. That doesn't make sense. Markets look calm on the surface, but every few months, something breaks behind the scenes. Nobody really knows why. So people keep asking themselves the same question. Why doesn't anything fully recover? The real story isn't even happening in the United States. It begins thousands of miles away, in Tokyo, Japan. And no, it's not about politics, elections, or the headlines you see on the news. It's something much quieter, yet infinitely more powerful. It is about U.S. bonds. For decades, Japan has been playing a massive role in the American economy that most people never notice. They were buying U.S. bonds again and again and again, quietly holding up the entire global system. To understand how we got here, we have to go back to the early 1990s. Japan collapsed. Their real estate crashed, stocks plummeted, and economic growth simply disappeared. Nothing recovered quickly. Years went by, and the Japanese economy just slowed down into what historians now call the lost decades. And unfortunately, it lasted much longer than anyone expected. So, the Bank of Japan did what central banks do when they panic. They cut interest rates to zero. Then, they pushed them below zero. And for years after that, money stayed near zero. Now pause for a second and think about this. You save your hard-earned money, but it doesn't grow at all. Now imagine you manage billions of dollars, pension funds, insurance money, and your return is completely zero. Naturally, you start looking elsewhere for an opportunity. You are forced to look outside your borders. Capital, by its very nature, cannot stay still. It either finds a way to multiply or it slowly suffocates. And then you see it. While Japan gives you a 0% interest rate, across the ocean in the US, you could earn 4 or 5%. Suddenly, the decision becomes obvious. You carry your money to the high interest rates in the USA. To do this, you borrow cheaply in Japan, convert those yens into dollars, and then invest them in the US to earn the difference. Simple. Almost too simple. This is called the yen carry trade. So, a massive tidal wave of money starts to flow into the US. But this money didn't just stay parked in government bonds. It spread everywhere. Into stocks, into real estate, and directly into tech companies. It moved quietly, but constantly. When money is this cheap and abundant, it never sits still. It moves into every corner of the market, causing prices to rise everywhere. It creates a global illusion of wealth where every asset class looks invincible simply because it is being flooded with borrowed liquidity. And this is the part most people completely miss. For years, this felt like a financial system that could never break. Money was flowing, asset prices were rising, and everything just worked. Think about the true scale of this operation. We are talking about trillions of dollars leveraged on a single dangerous assumption. The assumption was that Japan would stay frozen forever. Wall Street funds built a massive economic skyscraper on top of this 0% Japanese foundation. If you can borrow money for free, you never worry about the exit door. You just keep buying and inflating the bubble. As long as that foundation stays frozen, the skyscraper stands. But nothing in the financial market stays frozen forever. In reality, the longer a system remains artificially suppressed, the more violent the eventual awakening turns out to be. This entire system only works as long as the flow never stops. The moment it slows down, things start to feel off. In 2024, the fundamentals completely shifted. Japan raised interest rates for the first time in 17 years. Everything flipped. Borrowing and hedging aren't cheap anymore. The trade simply stops working, and the money goes right back to Japan. This is a mass exodus of capital, pulling down the scaffolding of global leverage as global liquidity actively leaves the US system. Stocks dropped and volatility returned because something invisible, the cost of money, had started to shift. Long-term bond yields don't move on a central bank's command. They move on pure market forces, simple supply and demand. With the giant gone, the US government is left with a mountain of debt. To attract investors, they must offer higher interest. The Fed is pushing short-term rates down, while the actual bond market is pulling long-term rates up. This creates a yield curve steepening. It's a brutal tug-of-war. The Fed pulls the rope down to make money cheaper, but the global bond market pulls it up. Today, the Fed cuts, and absolutely nothing happens to your mortgage. The mechanism is jammed. Central banks do not rule the world. Would you choose a safe 5% government return with zero risk, or a massive gamble on the stock market for the same 5%? Naturally, you choose safety. Riskier investments lose their shine and must become cheaper to attract your capital. Interest rates are the fundamental price of money. When the bond market backbone shifts, every asset on Earth gets repriced. Future earnings are discounted by today's interest rates. When rates go up, the future is worth significantly less today. The company doesn't change, but the ticker reprices itself. It is a silent devaluation showing up in your everyday life. This isn't just abstract theory anymore. Reality hit, because the bond market truly rules the world. The house you were thinking about buying, suddenly it feels completely out of reach. The loan that looked manageable last year? Now it doesn't. You have the exact same income, but everything feels tighter. not because you did something wrong, but because the system changed the rules of the game. Most people blame local politics or inflation, never realizing their domestic reality is being dictated by bond yields anchored all the way in Tokyo. This is why mortgage rates stay stubbornly high. They don't care about the Fed, they follow long-term bonds. As for businesses, this is why companies are starting to slow down. Borrowing has become too expensive, and credit is the literal bloodstream of the economy. When the bloodstream slows down, the extremities go cold first. Small businesses and average families feel the frost long before Wall Street does. The financial system is designed to protect the core. It shields massive institutions while leaving the everyday consumer to absorb the shockwaves of global restructuring. You sit at your kitchen table looking at the news. The headline says the economy is easing, but your daily reality says it is tightening. You are caught in the gap between the political narrative and the hidden math of global bonds. And the math never lies. For decades, the US benefited from this hidden system. Cheap money, strong demand, and constant global liquidity fueled by an endless supply of cheap credit. But now that entire system is shifting. Markets don't move on the volume of money alone. They move on the cost of money. Nothing breaks overnight. Your life looks the same. Your apps load, and your bank balance is there. The facade remains while structural pillars crack. Borrowing gets harder, growth slows, and prices stop making sense. The world must learn to operate without the invisible oxygen tank of free Japanese capital. When this cycle changes, only one question matters: what survives? The system is shifting, and understanding these cycles is the first step to navigating them. If this gave you a new perspective, consider liking and subscribing to join our journey. I'll see you in the next cycle.